Hello, Mr. Weintraub from Skagen.
Hello.
Could you explain a bit more about Skagen Funds?
Well, Skagen is kind of an unusual story, actually. For 20 years, it's fantastic development, really, for our clients. We started with investing our own money and our friends' money. We did it with a very conservative approach of finding undervalued companies all over the world, despite sitting in Stavanger, Norway. And with the success of the returns and happy clients, they spread the word. And boy, we're almost 200 people now and represented in a few countries where clients asked for our advice, and we ended up telling them, and even in Belgium.
Could you explain a bit more about your investment process?
Yeah, well, we have a basic investment philosophy to find undervalued companies, trying to value them, and then of course, that's easier said than done, and we work hard at understanding what companies do first, and only then do we price them.
In your presentation, you spoke about undervalued and underpriced and under-researched stocks, but won't that lead to mostly small caps?
Not necessarily. There are cycles where quite a lot of large caps are very much part of the 3 U's, as we call them. But of course, it is a little bit of a catchphrase. So instead of under-research among a large company, it is either misunderstood or in some cases even hated. And when it's hated, it comes quite far down in price. And we have a price-driven philosophy. We were very, very focused on what we pay for things.
In which zones do you invest?
I'm sorry?
Which countries and zones do you invest?
Well, there is no country or industry or zones per se that we don't invest in. Of course, we have some ethical considerations, but the price really leads us where there could be interesting opportunities. Most of it is company specific, but sometimes you have big dislocation for geopolitical reasons. That makes us start looking there. And make sure that there are assets that are falling in value for the wrong reasons. This is really what we're trying to find, for the wrong reasons. And most of them actually fall for the right reasons. So this is a lot of work to find the one that's very special.
And you don't do top-down research?
No, I think that's almost a contradiction in terms in investing, frankly. I mean, if you look at us as a detective, we have a criminal case you want to solve. Then we don't look at the criminal statistics on number of burglaries in Belgium. That doesn't lead us anywhere. We have to focus on the actual situation and the particular companies. So top down, again, like the dislocation, it might lead us somewhere, but we do not focus on that. Okay,
in your risk management process, you said you avoid or you don't use classical ratios like standard deviations. What's your typical risk management?
Well, let's talk about what standard deviation is. It's a movement historically. It doesn't really tell you much in the future. And it definitely doesn't tell you anything about risk per se. We look at the absolute return focus. Now, in an absolute return focus, you look at the company's underlying value creation and value creation going forward and risks from a fundamental basis. The stock price movement per se is not risk to us. In fact, it could be an opportunity for the active investor.